7-Eleven is leaving New York. Not one store, not 10, hundreds. A system that once covered the entire city is starting to disappear. For decades, 7-Eleven wasn't just a convenience store. It was part of the city's daily rhythm: morning coffee before work, a quick meal between shifts, a late-night stop when nothing else was open. It worked because New York never stopped moving. High density, constant foot traffic, millions of small transactions, every single day. But now, something is breaking. Stores are shutting down faster than they're opening. Entire neighborhoods are starting to feel the gaps, and the company behind it isn't slowing down. It's accelerating. This is not just a retail story. This is a signal, because when a global giant starts pulling out of one of the most valuable markets in America, it's not random. It's calculated. So the real question is, what changed so deeply that one of the world's biggest convenience chains is walking away from New York? 7-Eleven used to be infrastructure for urban life, not optional, not luxury, essential. Morning coffee on the way to work, a quick snack between shifts, a cheap meal when time was tight and money was tighter. It fit perfectly into the rhythm of New York. Fast, dense, always moving. The model was simple: high foot traffic, high volume, low margins. You didn't need to make a lot on each customer. You just needed a lot of customers. And New York delivered that better than almost anywhere else in the world. Millions of people moving through the city every day. Subways, sidewalks, office towers. Every block was a stream of potential transactions. That's what made small stores work. Tiny footprints, limited inventory, but constant demand. This is how urban retail survives, not by charging more, but by selling more, faster. Margin didn't matter as much as movement. As long as people kept walking in, the system held together. But that balance was fragile, because the entire model depends on one thing: consistency. Consistent traffic, consistent spending, consistent behavior. The moment any of those start to break, the math changes instantly. And in a city like New York, where costs are already higher than almost anywhere else, there's no room for error, no cushion, no margin for shock. So what happens when the flow slows down, even just a little? What happens when the system that depends on density starts losing it? Costs started rising, not slowly, relentlessly. Rent went up, labor got more expensive, regulations added layers of compliance. Every single line on the expense sheet moved in one direction, up. Running a small retail store in New York was never cheap, but now it was becoming unforgiving. At the exact same time, something else was happening. Foot traffic started to weaken, not collapse, not overnight, just soften. Fewer people stopping in, fewer impulse buys, fewer daily routines. And the change was subtle. A coffee skipped here, a sandwich replaced from home, a bottle of water no longer worth the price. Small decisions, almost invisible on their own. But across millions of customers, they compound. This is where the pressure builds. Because convenience stores don't rely on big purchases, they rely on frequency, daily habits, repeated spending, predictable behavior. When that breaks, revenue doesn't crash. It erodes, slowly, quietly. And that's more dangerous, because while revenue is slipping, costs are still climbing. There's no adjustment happening in sync, just a widening gap. Margins get thinner, operations get tighter, every dollar matters more. And remember, this is a business already running on razor-thin margins, 1 to 4%. That's it. There's no buffer here, so when customers start pulling back, even slightly, the impact is immediate. And in a city like New York, where everything already costs more, that pressure hits harder, faster, so now the system is under stress. Costs are rising, customers are spending less, traffic is weakening. On paper, it looks manageable. But in reality, this is where the foundation starts to crack, because the question is no longer about growth, it's about survival. And that leads to a bigger question. If rising costs and weaker demand are already pushing stores to the edge, what happens when something else hits the system at the same time? Margins in convenience stores are razor thin, 1 to 4%. That's all they have to work with, so even a small disruption can wipe out profit completely. Lose 2% of inventory, and you're already in trouble. Lose 4%, and the store is no longer viable. And that's exactly what's happening. The industry calls it shrinkage. Inventory that disappears. Not sold, not paid for. Just gone. But this isn't random shoplifting. This is organized. Groups walking in, taking products in volume, walking out in broad daylight. No resistance, no consequences in the moment. And it's happening again and again, at scale. For a business built on thin margins, this is devastating, because revenue might still look strong on paper. Customers are still coming in. Transactions are still happening. But a portion of that inventory never turns into revenue. It turns into loss. And the math breaks instantly. You can have a line out the door and still be losing money. That's the paradox. From the outside, the store looks busy. From the inside, it's bleeding. And once shrinkage crosses a certain threshold, there's no fixing it with more sales, no marketing campaign, no pricing strategy, because the problem isn't demand, it's control. Loss of control over inventory means loss of control over the business. And when that happens, closing becomes the only rational decision. This is the part most people miss. Retail doesn't die only when customers disappear. It dies when the system can no longer protect what it sells. So now the question becomes even more critical. If shrinkage is hitting stores across the country, why does it seem to hit New York harder than almost anywhere else? Laws started to change, quietly, gradually, but with massive consequences. The threshold for felony theft was raised. Prosecution became less aggressive in certain cases. Enforcement in many areas became inconsistent. On paper, these were policy adjustments, debatable, political, complex. But in the real world, retailers didn't debate. They measured. And what they saw was simple. Higher risk, lower consequence, more loss. So they responded. Not with statements, not with press conferences, with action. They started closing stores, location by location, market by market, not because they wanted to leave, but because the numbers no longer made sense. This is where the story shifts, because this is no longer about crime, it's about capital. Money doesn't argue. Money moves. When risk rises beyond a certain point, capital exits. It doesn't wait for conditions to improve. It doesn't stay loyal to geography. It reallocates to safer markets, to higher margin locations, to environments where the rules are more predictable. And New York is starting to fall on the wrong side of that equation. Stores get flagged internally. High shrinkage, high operating cost, low profitability. And once a location hits that profile, its future is already decided. This is how large corporations think, not emotionally, systematically. If a store cannot meet the required return, it gets cut, no matter how busy it looks, no matter how central it feels to the neighborhood. And when enough of those decisions stack together, you don't just lose stores, you lose infrastructure. Because retail isn't just about selling products. It's about access, convenience, daily life. So when capital starts pulling out, the impact doesn't stay inside corporate balance sheets. It spills into the streets, into neighborhoods, into routines, into entire communities. And that leads to a much bigger question. If capital is quietly leaving parts of the city, what comes next? Who fills the gap when the system that used to serve millions decides it's no longer worth staying? This is where the story flips, because this is not really about New York. It's about the business model. 7-Eleven is not collapsing. It's evolving. The company isn't shrinking. It's upgrading. Bigger stores, full kitchens, fresh, made-to-order food, even seating areas in some locations. This is not a convenience store anymore. It's becoming a hybrid. Part fast food, part retail, part daily habit destination, and the numbers prove it. These new format stores are generating around 18% more revenue than the company average. Higher ticket size, higher margins, more control over what gets sold. That's the future 7-Eleven is building toward. And that's the problem. Because most of New York can't support that model. The majority of stores are small, tight spaces, no room to expand, no space for kitchens, no way to transform. They were built for a different era, an era of quick transactions, limited options, maximum foot traffic. But the strategy has changed. Now it's about experience, food quality, higher spending per customer, and if a location can't adapt, it gets left behind. This is the part most people misunderstand. The company isn't being pushed out. It's choosing where to stay. It's reallocating resources towards stores that fit the new system. And walking away from the rest, New York isn't being abandoned randomly. It's being filtered, store by store, block by block, until only the locations that match the new model survive, which leads to a much deeper implication. Because if a city like New York, one of the densest, busiest markets in the world, can no longer support basic convenience retail, what does that say about its economic structure? What does it say about cost, risk, and sustainability? And more importantly, if even low-cost, everyday retail can't make the numbers work here, what happens to everything else built on top of it? Small stores will disappear, quietly, one by one. And when they do, they leave behind empty spaces, dark windows, closed doors, gaps in neighborhoods that used to rely on them every day, and those gaps don't always get filled, especially in lower-income areas, because the same factors that pushed 7-Eleven out keep new businesses away. High costs, high risk, uncertain returns, so the space stays empty, or worse, it disappears from the retail map entirely. But the money doesn't disappear. It moves away from dense urban cores, toward suburbs, toward higher income zones, toward markets with lower risk and more predictable returns. New stores will still open, just not here, not in the same neighborhoods, not serving the same people. That's the shift. Capital is not leaving retail. It's leaving certain places, and when that happens, opportunity moves with it. So the real question is, if capital keeps flowing out of the city, who or what is left behind?